I gotta give me a pen and paper. Go ahead. I'm listening.
All right, so peace, power, and profit. This is another exclusive. We the best.
Boy, crazy.
Uh,
I can't take it.
yeah, man. So, all right, man. We back. We back on these options. Trying to, give everybody a full picture and understanding this trading strategy works. So we're gonna go over the fundamentals real quick, and then we're gonna get into more detailed description.
What sport does Keon do?
Oh, what does Keon do?
Basketball.
Oh, that basketball.
Okay. All right. So fundamentals. Investors utilize options to speculate or bet on market price movements, protect their portfolios from risk, and make income. Each strategy has its own unique set of risks, benefits, and typical investors. Options are contracts between two parties. On one side, the contract buyer gains the right to perform a specific transaction at a fixed price. On the other contract, on the other, the contract seller is obligated to fulfill the buyer's right. For example, if an option buyer has the right to purchase stock at $50, the option seller must sell the stock at $50 if the buyer exercises their right. Options don't last forever, each maintains a defined expiration date in the future. Most options expire within 9 months after issuance, but longer term options exist. The option the option buyer has until expirations to exercise their right. If the option is not exercised by expiration, it expires and no longer exists. Standard options that maintain expirations of up to 9 months typically expire on the third Friday of the expiration month at 11:59 p.m. Eastern Standard Time. Like most securities, options are issued to investors, then are traded in the secondary market. Option issuance is unique as compared to other securities. Options primarily trade in Chicago on the CBOE, which is Chicago Board Options Exchange. Chicago is in the Central Time Zone, which is 1 hour behind Eastern. For those of you that didn't know, uh, while many options expire 9 months from issuance, there are some exceptions. Weekly options expire in 1 week, issue on a Thursday, and expiring the following Friday. Weekly options allow investors to make very short term bets on price fluctuations. LEAPs uh, stand for long term equity anticipation securities, all long term options that last up to 3 years. These type of options allow investors to bet on stock prices over longer periods. Okay, equity and index options. Options are considered derivative securities, which are investments that obtain or derive value from price changes in an underlying asset. The underlying asset could be a stock, an index, a currency, or a commodity. When the market values of these assets fluctuate, so do option values. For example, an option that allows an investor to buy stock at $50 gains value as the stock's market price rises. If the market price goes to $90, the option allows a stock purchase $40 below its market value. The higher the market price rises, the more valuable the option, and vice versa. There are two primary types of options contracts: equity or stock options and index options. Equity or stock options derive their value from the price fluctuations of a specific stock. For example, if you bought or sold an Apple Inc. ticker AAPL option, you will pay close attention to Apple's stock price. Depending on the position you invest in, you may make money if Apple stock price falls, is flat, or rises. You could use an Apple option to speculate on its price, protect your Apple stock investment, or make additional income in your portfolio. Index options derive their value from fluctuations in a specific index value. For example, you can invest in an S&P 500 index option that may provide a return if the index value falls, is flat, or rises. Index options are used to speculate on general market movements, make additional income, or protect entire portfolios from market risk. All right. So this is long options. This is what Mo had trouble understanding, the word long, right? So most people feel like they're learning a new language when they encounter options for the first time. To successfully master this concept, understanding the vocabulary is vital. One of the most important elements of options language relates to buying and selling contracts. Long is a term used across the securities industry. If an investor is long a security, they purchase and continue to hold the security. We also use this term with options, although its meaning is slightly more complex. When an investor goes long in an option, they are buying a contract that gives them a specific right. Known as a holder, investors with long options maintain the right to buy or sell an asset at a particular price, depending on the contract. The cost of an option is known as its premium. Option buyers pay a premium to purchase an option. A specific right is provided in return. The more valuable the option, the higher its premium. For example, if the market price of a stock is $70 and an options contract provides the right to buy the stock at $50, the premium will be at least $20 per share. Premiums are determined in the options markets and function similarly to stock prices. The more demand for an option, the higher its premium, and vice versa. Premiums can be expensive. Accordingly, holders need their options to make a return to offset the options cost. Purchasers of options incur a debit or a cost to go long. A bad scenario for an option holder is for their option to expire unused. If this occurs, they are left with a loss equal to the premium paid for the option, the maximum potential loss for a holder. All right, definitions. The definition for debit is money paid to purchase an investment. Assume an investor purchases an option that provides the right to buy a stock at $50. If the stock's market price falls to $40, the buyer will not use the option. Why would they exercise their option and buy stock at $50 when they can go to the market and buy it for $40? In this scenario, the option has no intrinsic value. Definition: exercise. Using the right that an option provides. Only holders, purchasers of options can exercise. All right. Intrinsic value. Intrinsic value is the profit the holder makes when an option is exercised. When exercise is not profitable, like in a previous example, the option lacks intrinsic value. Options without intrinsic value are referred to as out of the money, or OTM. In the previous example, the option was out of the money by $10. If an option remains out of the money on the expiration date, it expires worthless. At this point, the holder absorbs their maximum potential loss, which is the premium paid for an option they didn't use. Let's again assume an investor purchases an option that gives them the right to buy the stock at $50. If the stock price rises to $75, they can lock in a significant gain by exercising their option and buying the stock at $50. After the exercise, they can take the stock to the market and sell it for $75. When an option is in exercise territory, it has intrinsic value. In this example, the option has $25 of intrinsic value. An option with intrinsic value is known as in the money, or ITM. In summary, option purchasers or long options are known as holders. Holders pay premiums, creating a debit. to gain the right to transact at a fixed price before expiration and hope to exercise the option if it goes in the money or gains intrinsic value. All right. Short options. When investors sell an option, they go short. The terms sell and short are used interchangeably with options. When an investor sells an option, they may be placing themselves at considerable risk. To fulfill the rights provided to the holder, sellers obligate themselves to do something they most likely want to avoid. However, option sellers force themselves into this position by receiving a premium in return for their obligation. Why would anyone obligate themselves to do something they didn't want to do? What's the answer to 99 out of 100 questions? Money. Option sellers are credited a premium when they go short options. It's a short-term benefit in exchange for selling an option, which may turn out to be a good or bad move. In the best case scenario, the option expires worthless and the investor is no longer obligated to participate in any transaction. Definition: credit is money received to sell an investment. Option sellers are also known as writers. An option is a contract between two parties, and the seller is metaphorically writing up a contract and selling it to another investor. If the option holder has the right to buy the stock at a fixed price, the option writer is obligated to sell stock at that price. Conversely, if the option holder has the right to sell stock at a fixed price, the option writer is obligated to buy the stock at that price. Writers hope the options they sell expire worthless and avoid gaining intrinsic value. As a reminder, intrinsic value represents the profit made by the option holder if an option is exercised. The holder's profit is the writer's loss. The more intrinsic value a contract has, the more the writer loses. Therefore, the writer hopes their option stays out of the money, OTM, and has no intrinsic value. Let's work through a few examples to understand this better. If an investor sells an option that gives the holder the right to buy stock at $50, therefore the investor, option seller / writer, has the obligation to sell the stock at $50, but only if the holder exercises. If the market price goes to $45 per share, the holder will not exercise the contract. Why would the holder exercise and purchase shares at $50 when the market is trading the stock at $45? The writer is not forced to do anything if the market price stays there through expiration. They make their maximum gain minus the premium received when the option was sold. This option had no intrinsic value and was out of the money at expiration. This is exactly what they hoped for. Conversely, let's say the stock instead goes to $70 per share. At this point, the holder will definitely exercise their right to buy the stock at $50. The contract maintains $20 of intrinsic value and is in the money. When a writer's option is exercised, they are assigned their contract and are forced to perform their obligation. In this example, they must sell the stock at $50. If they don't already have the stock in their possession, they must go to the market and purchase it at $70. Essentially, they're buying stock in the market at $70 and selling it at $50 to the option holders, locking in a $20 per share loss. The writer still keeps the premium, which may not offset the losses realized when the contract is assigned. This is why option sellers hope their contracts go unexercised. Writers hope to receive premiums and never hear back from the holder. Assignment results in the seller being forced to perform an unprofitable transaction. In summary, option sellers are short options and are known as writers. Writers receive premiums, creating a credit in return for obligating themselves to perform a transaction at a fixed price. Option sellers hope their options remain out of the money without intrinsic value and expire worthless. All right. Let's see. Let's go through these key points. Option contracts, derivative securities provide the right to perform a transaction at a fixed price, can be used for speculation, protection, or income. Derivative securities obtain value from the underlying asset. Option expiration, standard options have expirations of up to 9 months, typically expire at 11:59 p.m. Eastern Standard Time on the third Friday of expiration month. Option buyers obtain a right to perform a transaction at a fixed price. Option sellers have an obligation to perform a transaction at a fixed price. Leaps, long-term options of up to 3 years. Equity or stock options derive value from stock prices. Index options derive value from index levels. Long options, right to exercise the contract. Bought option contract, debit. Investors are holders and seek intrinsic value. Short options, obligation to do the transaction if assigned exercise or exercise. Sold option contract, credit. Investors are writers, want to avoid intrinsic value. Mo,
Yes.
we good?
Go to the beginning.
Yeah.
Okay. Yeah, I'm good. That was good. That was good info.
Yeah, that's what we needed to cover before what we went into last week.
Okay, good.
All right, so
Thank you. That was really good.
all right, so let me go back up here.
Share the show, y'all.
Please do. It's the last time it's gonna be free. Okay. All right. So next is it's called issuance in the market, right? You ready?
Yes.
All right. So like most securities we discussed, options contracts are issued, then traded between investors in the secondary market. Anybody confused on what the secondary market is?
That was be when they offer it to us.
When it's public.
When it's public, yeah.
I mean, we'll cover the different markets later. For right now, it's not necessarily important, but all right. So, however, there are some unique characteristics relating to the options markets. This chapter. All right. So, issuance. Normally, the issuer of a security is the organization directly tied to the security. So, to point this out, y'all do know that when you buy stock on any of these brokerage sites or applications, that you're not really buying it directly from the company, you're buying it from the issuer or that broker. Y'all understand that?
I figured that when when like, okay, for example, when GameStop went out of control and they stopped you from trade, they probably had a certain amount of money to be dealing with. Yeah, I figured it was from the broker, not the direct out.
Yeah. So you can't buy stock from Nike. You have to buy it through the issuer, which would be a Fidelity, a Charles Schwab, a Stash, so forth and so on. All right, so normally the issuer of a security is the organization directly tied to the security. There is only one issuer with options, the Options Clearing Corporation, or the OCC. The OCC is responsible for issuing options, standardizing contracts, and guaranteeing performance. Regardless of the issuer of the underlying security, options are always issued by the OCC. For example, the OCC issues a McDonald's Corp stock option, not McDonald's, which we just went through. Essentially, the OCC creates the structure for options when issuing contracts, and then investors trade them in the secondary market. Each option contract is standardized, which allows for easy trading. We're going to learn more about the structure of all that later. If contracts were customizable, it would be tough to negotiate trades with other investors. Imagine the difficulty of trading if every contract had different specifications and requirements. You would spend most of your time examining contract specifications instead of researching the underlying securities. The OCC also guarantees option performance, which assures a transaction will occur if an option is exercised. What if you exercised a long option and the writer didn't fulfill their obligation? The OCC's job is to ensure that option contracts work as they should. If a writer doesn't do their part, the OCC makes sure that the exercise still happens. So you ain't got to worry about that. You will get your money. All right. Last, the OCC is a clearinghouse, sometimes called a clearing agent for the options markets. Clearinghouses ensure options transactions execute properly after a trade is made. All right. So, secondary market. Investors trade option contracts in the secondary market after their initial issuance by the OCC. Trading in the options markets primarily takes place on the CBOE, Chicago Board Options Exchange. It's like the New York Stock Exchange of options, where traders buy and sell options contracts with other investors. Premiums are determined by demand in the market, just like stock prices. If there's more demand for an option, its premium will rise and vice versa. When an investor buys or sells an option contract, the trade settles in one business day, or what we call T+1. However, if a stock equity option is exercised, the settlement time switches to 2 business days, T+2. During an equity option exercise, a stock transaction is occurring. If you recall, stock transactions have a settlement time of 2 business days, T+2. So y'all might want to remember that.
T plus two?
Yeah, so you want to remember what days the money settle in your account. Let's say you buying and selling, and you want to take that money and buy another options contract. They settle differently.
Okay. What's T+2?
That's the trade day plus 2 business days.
Oh.
Trade plus 2 business days, basically. So you know how when your cash settle in your account, they say, oh, the cash won't settle for up to 3 to 5 business days. Well, technically, it's 2 business days or whatever. T+2.
I got you.
All right. Hold on 1 second. All right. What is winning something else? Okay. All right. So holders must exercise their contracts before they expire. If you recall, standard options expire within 9 months of their issuance. Options contracts reference the month they expire. For example, Coca-Cola Inc., ticker KO, January stock option expires on the 3rd Friday of January, technically at 11:59 p.m. Eastern Standard Time, 10:59 p.m. Central Standard Time. The expiration date is typically referred to as Expiration Friday. In addition to options expiration, there are a few other times to be aware of. The options market closes at 4 p.m. Eastern Standard Time, 3 p.m. Central Standard Time. The normal closing time for most stock markets open from 9:30 a.m. to 4 p.m. Eastern Standard Time, Monday through Friday. This time is also the trading cutoff for options on expiration Friday. Although options cannot be traded after 4 p.m. Eastern Standard Time on the expiration date, option holders have until 5:30 p.m. Eastern Standard Time to contact their broker-dealer and request their contract be exercised. So I just wanted y'all to know that. Did y'all know that?
No, I ain't really had up to 5. I knew it stopped at 4.
Right.
No, I didn't.
So yeah, so you can call the broker and tell them to close it out by 5:30 p.m. Eastern Standard Time.
I know a couple times I forgot to close it, and they closed it for me. I was so happy because I was.
Okay. They closed it for you.
Yeah, they exercised it.
Okay. I didn't know they do that. I know they do that when it expires.
Oh, maybe mine expired then.
Yeah.
I was in the money.
Okay. Well, it expired. Well, they exercised it for you?
Yeah, like it closed out. Yeah, because once it gets to the expiration date, it's gonna close regardless. I didn't hit the trigger.
Okay. I didn't know it did that.
Yeah, I had forgot.
Okay.
Hey Mo, wasn't that on your trade, your pharmaceutical trade?
Um, it was. I don't remember. I just remember that I did it before. Like I was like, dang, I forgot I was trading.
It wasn't the one with Moderna?
No, I actually, I closed my Moderna out at this peak. Not, I didn't close it all over. I closed some. I closed the options, but the share. I'm sorry. No, I had shares in Moderna, not options. It may have been something else I had. I don't know. Well, Chris,
Uh-huh.
that
I
little
think you
stuff.
had a Ford option.
Yeah, Ford. Ford. It was Ford, Twitter, and oh, I didn't play AMC. Y'all play AMC. Chris, can you read that last paragraph you just read, or the last 3 things? The one that starts off with the trading day.
Okay. It says, in addition to option expiration, there are a few other times to be aware of. The options market closes at 4 p.m. Eastern Standard Time, 3 p.m.
Yeah.
Central Time. The normal closing time for most stock markets open from 9:30 a.m. to 4 p.m. Eastern Standard Time, Monday through Friday. This time is also the trading cutoff for options on expiration Friday. Although options cannot be traded after 4 p.m. Eastern Standard Time on the expiration date, option holders have until 5:30 p.m. Eastern Standard Time to contact their broker dealer and request their contract be exercised.
Okay. Thank you.
Mm-hmm. All right. All right. Opening and closing transactions. When an option trade occurs, it will either be an opening or closing transaction. There are 4 types of option transactions to be aware of: opening purchases, opening sales, closing purchases, closing sales. When an investor establishes an options position, they engage in an opening transaction. Opening transactions represent the beginning of a contract between 2 parties. Investors that establish long option positions are executing opening purchases, while those that establish short options positions are executing opening sales.
Mm.
We got that?
You said opening purchase is long option positions and opening sales is short option positions?
Yes.
Got it.
What is the opening transaction?
Opening transaction
Yeah.
when you first buy.
When an investor establishes an options position, they engage in a opening transaction.
Transaction.
Okay. And what is opening sales?
Long options.
No.
What?
When you open a position and you're waiting for the position to close.
Wrong.
I thought you just said, Brandon, your turn.
You said opening a sales position.
No,
What is
what's the open sales?
what is opening sales?
So if I had to take a wild guess.
Short. Option short. I'm sorry, Brandon. Go ahead.
No, you don't said my answer.
Yeah. Yeah, you done took Brandon.
I'm sorry.
Damn it.
I'm just making sure that we get this right. So, what is open?
Purchase is when you get a long option, and opening sales you get short options. Short expiration date, I guess.
No, short option position.
Short option position, yeah.
Opening sales is those that establish short options positions are executing, and opening purchases or long options positions are executing.
Gotcha.
An opening transaction is what?
When you first buy it. When you first get a position.
When an investor establishes an options position. Okay?
Yeah.
All right. All right. So let's go through some examples real quick. An investor opens an options account at their broker dealer and immediately establishes one long March 50 call at $5. What type of options transaction was performed?
Wait, say it one more time. Sorry.
An investor opens an options account at their broker dealer and immediately establishes one long March 50 call at $5. What type of options transaction was performed?
Open.
Huh?
One. Well, you ain't give the date.
You don't need the date is March.
Open
Doesn't matter about the date.
Open purchase. Established position. Open.
Listen again. An investor opens an options account at their broker dealer and immediately establishes one long March 50 call at $5. What type of options transaction was performed?
Open purchase.
You sure?
2 words that he said, Mo. That should be a clue.
Long
And
purchase.
What is
long call.
Call.
it? Is an opening purchase.
Okay.
Why is it an opening purchase? There's 2 reasons why.
First, you want to do it right now.
Wrong.
Well,
Remember the definition. Okay, so first.
Go ahead. First what?
So the first reason why is the investor is establishing a new position. Secondly, the buyer is going long.
Got it.
All right. All right, one more. An investor opens an options account at their broker dealer and immediately establishes one short October 90 put at $8. What type of options transaction was performed?
Open sales. Short is the key word. I mean, you go
Correct.
Oh, don't be so.
All right. Okay. Investors can exit an options position before it is exercised or expires by trading their position to another investor. We'll need to think about this from two separate perspectives: closing long positions and closing short positions. Did y'all catch that?
Say it one more time.
Investors can exit an options position before it is exercised or expires by trading their position to another investor. We'll need to think about this from two separate perspectives: closing long options and closing short options.
Okay.
When an investor buys or goes long in an option, they can sell the contract later. If you own an option that gave you the right to sell stock at $50, long 50 put, another investor might be interested in your contract. You could sell the contract for the option's current premium, known as a closing sale. It's closing because you got out of the position. It's a sale because you sold your contract to another investor.
Got it.
Okay. Everybody else good with that?
Yeah.
All right. The exact opposite occurs with option writers. Assume you initially establish a short position that results in an obligation to buy the stock at $50, short 50 put. You can get out of the contract by finding another investor to take over your obligation. This can be accomplished by returning to the market and buying the same position, the same option contract from another investor. When you buy the same contract in the market, the investor selling the option now takes over your obligation. This transaction will be considered a closing purchase. It's closing because you got out of the position. It's a purchase because you bought an option to exit the contract.
Yeah.
Everybody good?
Yep.
All right. Closing purchases and sales can be confusing, but keep it simple. When an investor buys or sells an option as an initial transaction, they can close the position out before exercise or expiration. Option holders, the long side, sell their contracts to close their positions, while option writers, the short side, buy their contracts to close their positions. We good?
Hey, say that again one more time.
Okay. I'll repeat the whole thing. Closing purchases and sales can be confusing, but keep it simple. When an investor buys or sells an option as an initial transaction, they can close the position out before exercise or expiration. Option holders, the long side, sell their contracts to close their positions, while option writers, the short side, buy their contracts to close their positions. Got it?
Got it.
All right. Let's go through a few examples. All right. So an investor opens an options account at their broker dealer and immediately establishes one short December 25 call. 1 week before expiration, the investor requests to exit their position. What option order must be submitted to execute the transaction?
Close sale? No, right. Yeah, close sale. You said once, so repeat it one more time.
Okay. An investor opens an options account at their broker dealer and immediately establishes one short December 25 call. 1 week before expiration, the investor requests to exit the position. What options order must be submitted to execute the transaction?
Close sale.
Brandon?
You said close sale?
That's what I said.
Yeah, that's what Mo said.
I'm gonna go with Mo on this one.
Nobody didn't buy it.
But what is he doing? He's getting rid of
Remember,
He's short. He's short. He's selling it. He want to get out of it.
so he established one short December 25 call.
Uh-huh.
And then 1 week before the expiration, he requests to exit the position. What options order must be submitted to execute the transaction?
a short buy.
We ain't talk about no short buys.
We talk about exiting position though, right?
He want to exit it. Then
Yeah.
what?
Yeah.
He want to open
So
sale?
Would it be a rollover?
No, remember what the contract is. It's one short December 25 call. What options order must be submitted to execute the transaction?
Close sale.
That's your final answer?
Yep.
Wrong.
Okay. There can't be no short buy price. You ain't talk about that.
It's closing purchase.
Damn it.
Remember.
Oh yeah, because somebody else gotta get it. See, I thought it was only closed purchase is if somebody else bought it.
Remember.
Do it again.
Yeah, he's
do it
right.
again.
The only way you can close a purchase is if somebody buys it.
Right.
But nobody
Closing.
bought it.
It's closing because you got out of the position. It's a purchase because you bought an option to exit the contract. Remember,
So it's
short
only way
call.
would if somebody would have bought it when he got out of it, it would have been a closed sale. Yep, I got it. Keep going.
No, you have to sell the contract.
Well, how do you get out of it for it to be a closed purchase?
It has to be after you sell it, after you sell the contract, then someone has to buy it at that price for it to be a closed sale.
So as long as no one has purchased it yet, it's a closed purchase.
Okay, I'm gonna read these definitions again. Okay.
Yeah.
If no one's purchased it yet, then damn, I missed it. I don't want to say in limbo. I think he said it's in closed transaction or sale transaction, something like that.
Oh, I'm gonna read it. We gonna go
Read it
over it
again
again
because even the chat's
because
trying to.
this is confusing. When an investor buys or goes long an option, they can sell the contract later. If you own an option, that gave you the right to sell the stock at $50, just long 50 put. That's an example. Another investor might be interested in your contract. You could sell the contract for the option's current premium, known as a closing sale. It's closing because you got out of the position. It's a sale because you sold your contract to another investor. So,
But the
like
scenario you gave, he didn't sell it. He just got out of it. So getting out of it means selling it.
no,
Yeah.
Mo. And then in the example, remember, it's a short call. You got to pay attention to that. What did I just read? Let's go back. When an investor buys or goes long an option, they can sell the contract later. Remember, when an investor buys or goes long, remember the question asks, or the question said rather, short call. That's not long, that's short.
That's why I thought it was a closed sale because it was short. But okay.
Okay, let me read on so we can get this down. So when an investor buys or goes long an option, they can sell the contract later. If you, excuse me, if you own an option that gave you the right to sell stock at $50, look, listen to this. If you owned an option that gave you the right to sell stock at $50, that's a long 50 put, another investor might be interested in your contract. You could sell the contract for the option's current premium, known as a closing sale. It's closing because you got out of the position. It's a sale because you sold your contract to another investor. So remember, a long put or a long call is always going to be a closing sale because you're closing, you're trying to get out of the position and then you sold it to another investor. When you're short, you're selling. When you do a short call, it's kind of like they inverse.
I got you. I got it.
You sure?
Closed purchase, right?
Right.
Shorts is short is closed purchase and loans are closed sales. I got it. I wrote it down.
Okay. Okay, I'm about to read this again. Okay, no, this next part. The exact opposite occurs with option writers. Remember, this is a buyer. This is a holder. A closing sale is a holder. That's the buyer, right? The exact opposite occurs with option writers. Assume you initially established a short position that results in an obligation to buy the stock at $50 or a short 50 put. You can get out of the contract by finding another investor to take over your obligation. This can be accomplished by returning to the market and buying the same option contract from another investor. When you buy the same contract in the market, the investor selling the option now takes over your obligation. This transaction will be considered a closing purchase. It's closing because you got out of the position. It's a purchase because you bought an option to exit the contract. You got that?
Got it.
You wrote that down?
Mm-mm.
Closing
Yeah.
purchases and sales can be confusing, but keep it simple. When an investor buys or sells an option as an initial transaction, they can close the position out before exercise or expiration. So either one, whether you're buying or you're selling, whether you're going long or you're going short, you can exit the contract at any time before expiration. Now, option holders, the long side, sell their contracts to close their positions, while option writers, the short side, buy their contracts to close their positions. All right, so we good with that.
Got it.
All right, here's another question. An investor opens an options account at their broker dealer and immediately establishes one long June 65 put 1 week before expiration. the investor requests to exit the position. What options order must be submitted to execute the transaction?
Close sale. You
You
said,
sure?
yep, you said if they do a long put. Wait a minute, read the question again.
Okay. An investor opens an options account at their broker dealer and immediately establishes one long June 65 put. 1 week before expiration, the investor requests to exit the position. What options order must be submitted to execute the transaction?
Close sale. You said when they buy a long put, they sell it to execute it is a closed sale.
Anybody else?
I'm gonna go with Mo on that one.
All right.
All right.
Don't be
Yep.
scared, Sonny. I wrote it down.
I'm gonna
Yep.
go with Brandon on that one.
What?
Yeah.
Well, I don't get no love in these lives, I swear.
Mhm. All right. So it is a closing sale.
Mhm.
All right. So, all right. So, all right. Key point. Options Clearing Corporation, OCC, responsible for each of the following: standardizing options, issuing options, guaranteeing option performance, and clearing trades. Options trades occur on CBOE, Chicago Board Options Exchange. Premiums are determined by supply and demand. They settle in 1 business day, T+1. Option exercises settle in 2 business days, T+2. Option expiration, 3rd Friday of the month at 11:59 p.m. Eastern Standard Time. Trade cutoff is 4 p.m. Eastern Standard Time. Exercise cutoff is 5:30 p.m. Eastern Standard Time. Opening transactions, start option positions, 2 types: opening purchases and opening sales. Closing transactions, end option positions, 2 types: closing purchases and closing sales. All right, so let's take a quiz on this. Let's take a quiz. All right. An investor comes to your office to open a new options account. After the account is approved, the investor wants you to place a trade to obtain a right to sell Disney stock at $110. What type of transaction should you submit?
Repeat.
An investor comes to your office to open a new options account. After the account is approved, the investor wants you to place a trade to obtain a right to sell Disney stock at 110. What type of transaction should you submit? They want you to place a trade to obtain a right to sell Disney stock at 110. What
Oh,
type of transaction should you submit?
closed sale.
Okay. You sure?
Mm-hmm.
Anybody else?
You try to change the words up a little bit.
No. Let's see
No.
if you had. No. If you had the right thing on screen, you would know. We read the definition of.
Can you repeat the question?
Okay. The investor wants you to place a trade to obtain a right to sell Disney stock at 110. What type of transaction should you submit? A opening purchase, a closing purchase, a closing sale, or opening sale?
Right the open close.
Open and purchase.
You sure?
Yeah.
They want to sell it, right? You said the right to sell. You said
Yes.
the
No, they wanted to
open.
get some Disney stock.
Let's do it again. After the account is approved, the investor wants you to place a trade to obtain a right to sell Disney stock at 110. What type of transaction should you submit? Opening purchase, closing sale, closing purchase, or opening sale?
Closing purchase.
Okay. You got closing purchase. Mo, what you say?
Me,
Yeah.
I said close sale.
Okay. Brandon?
Opening sale.
Okay, so y'all all three pick something
Right.
different.
Open sale.
So Sonny said closing purchase. Mo said closing sale, and Brandon said opening sale. Correct?
Yep.
I'm gonna tell y'all where y'all went wrong after I give y'all after the answer. All right.
Okay. Let me write it down. I wrote this.
It's an opening purchase.
That's what I said.
You said closing purchase.
Well, you only gave us 3 options.
No, it was 4. Opening
It's
purchase,
4.
Oh,
closing sale.
I didn't hear the opening purchase.
Oh, okay. So
Okay.
this is why. So remember rights and obligation. The buyer has a right, the seller has the obligation. So the customer placed a long put. They want an opening transaction, which creates a new option position. The only way they gain the right through an option is to go long, a purchase. Remember, right means buyers. Everybody cool?
You say right mean what?
When you obtain a right, that means you're a buyer, you're a holder.
Oh, I got it. Yeah.
Obligation means you have the obligation to sell.
Yeah.
All right, next question. An investor comes to your office to open a new options account. After the account is approved, the investor wants you to place a trade to obtain a premium in return for placing them into an obligation to buy Disney stock at $90. What type of transaction should you submit?
Close purchase.
After the account is approved, the investor wants you to place a trade to obtain a premium in return for placing them into an obligation to buy Disney stock at $90. What type of transaction should you submit?
Open sale. Open sale.
You said open sale. So
it's money right now. You said it
your
buy. Huh?
the answers are closing sale, opening purchase, closing purchase.
Do they have the right?
No, he said they buy.
Hold on. The investor wants you to place a trade to obtain a premium in return for placing them into an obligation to buy Disney stock at $90.
Oh, opening sale.
Get out of here. I can't go to school.
Okay.
What?
Sonny got opening sale. What you got?
I'm saying opening sale.
I'm gonna be.
Mo?
I don't know. Zion over here messing with me about his foot. I can't go to school. Get out of here. My foot is bleeding. You going to school. I'm gonna lose too much blood. Zion, get out. Let me put this on mute because I don't know what you're talking about, Chris, because I'm driving.
Huh? Oh boy, Mo always got something.
Well, that's what happens when you got kids.
Right. So I guess you ain't gonna answer the question.
I don't even know what you said. Repeat. Zion, leave me alone. I'm in class.
Can I get one of your water?
Take a water and go.
Okay, thanks.
After the account is approved, the investor wants you to place a trade to obtain a premium in return for placing them into an obligation to buy Disney stock at $90. What type of transaction should you submit? Closing sale, opening purchase, closing purchase.
Why you turn the damn light on?
Oh Lord.
Zion messing with me. I'm sorry. Just go and give the answer so I can be ready for the next one because I'm about to beat him.
All right. So Brandon and Sonny both said opening sale. That's correct. All right, next question. An investor holds a put option contract in their brokerage account. Assuming it is the contract's expiration date, what statement is false? Here's the
What?
statement. An investor holds a put option contract in their brokerage account. Assuming it is the contract's expiration date, what statement is false? The cutoff time to trade the contract is 4 p.m. Central Standard Time. The option will expire at 10:59 p.m. Central Standard Time. The cutoff for submitting exercise instruction is 4:30 p.m. Central Standard Time. The contract should only be exercised if it is in the money.
See.
Okay, here's the question again. Those were the answers. An investor holds a put option contract in their brokerage account, assuming it is the contract.
B is the answer. B, 10 p.m. thing. Go ahead.
It ain't no B, Mo.
Oh, ABC.
It's crazy. Yeah. Can you finish it?
Yeah. Assuming it is the contract's expiration date, what statement is false? Is it the cutoff time to trade the contract is 4 p.m. Central Standard Time? The option will expire at 10:59 p.m. Central Standard Time. The cutoff for submitting exercise instructions is 4:30 p.m. Central Standard Time, or the contract should only be exercised if it is in the money.
The contract
The
should be on
the cutoff for submitting the exercises, it ends at 4:30 Central Time.
the extra should be cut off in the money. In the money is the wrong one.
Okay.
Brandon?
Now remember what statement is false, not what it is true.
Right. Because you have up to 5:30 Eastern
Oh, it says
Standard. So
it says what statement is false?
Yeah.
Yeah, I'm gonna stick with the same one.
You sure?
I'm sticking with mine. Well, he wasn't here when you talked about the extended 5:30 instruction thing.
Yeah, he was.
Well, he wasn't paying attention then.
Oh.
He said, oh. All false. No, it could be all false.
Okay. So, all right.
What do you think, Brandon? I can't hear you.
Brandon sleep.
He sound very muffled and low.
Oh
Good.
yeah.
Give us the answer.
Y'all both was wrong.
What? Then his number.
The cutoff time to trade the contract is 4 p.m. Central Standard Time. that answer is false.
Because you got up to 5:30.
Well, no, because all the answers, the option will expire at 10:59 p.m. Central Standard Time is true. The cutoff for submitting exercise instructions is 4:30 p.m. Central Standard Time. It's
It's
true.
true.
The contract shall only be exercised if it is in the money. Is true. The
What?
cutoff time to trade the contract is 4 p.m. Central Standard Time. Is false.
Oh, I didn't hear Central Standard Time. Yeah, I would have said that.
Yeah.
So I missed the time zone.
Yeah, it's all good. All right.
Yeah,
Y'all
you
want to
missed.
keep going through questions, or y'all want to go to the next section?
We can go to the next section.
Go through the questions. This should have me dying.
All right, Sonny. We can go through them. Go ahead.
No,
All
it's a learning experience though, but you're really supposed to be really paying attention and really on it.
Yeah. Yeah.
I'm learning a lot. Come on.
What y'all want to do? Keep running through the questions or go to the next section?
You go through the questions.
All right. It's set.
How many is it?
We
How
got
many
13 more. It's 17 total.
How many we got left?
13.
Okay.
It's up to y'all.
All right, go through like another 3.
All right. We go through 3 more questions and then we move on. All right. One of your current customers is short an option in their account. They're concerned about volatility in the market and want you to place a trade that ends their liability. What type of option transaction should you submit?
Purchase. Open purchase. That
Mm,
is their liability. They want to do it right now.
Hold on. They're
So it's a
concerned.
short.
They're concerned about volatility in the market and want you to place a trade that ends their liability. What type of option transaction should you submit? Open
what
it.
Close it.
Closing sale.
Close sale.
What you
I'm gonna
say,
say
Brandon?
closing sale.
I was gonna say, can you read through the answers right quick so we can pick?
Okay. All right. I'm gonna read the question and then I'll read the answers. They're concerned about volatility in the market and want you to place a trade that ends their liability. What type of option transaction should you submit? Opening sale, closing sale, closing purchase, or opening purchase?
I want to say open sale.
Okay.
I'm gonna say closing purchase.
Close sale.
Let's y'all find out.
Close
Okay.
purchase.
Y'all all 3 got different answers. It's funny. All
Closing
right.
purchase. Because it's a liability. You're closing it. Yeah, I'm gonna say closing purchase.
So you said closing purchase too, Mo?
Yeah, because you didn't say long or short.
But it says ends their liability.
That's right now. Close sale. Right?
Okay. You said close sale.
Yeah.
Sonny said close purchase. Brandon says opening sale.
Yep.
Yeah.
All right, let's go with it.
We got it all wrong, right?
Sonny was right. Closing purchase.
I figured it when he say long or short.
Yeah, let's go, Sonny.
I was gonna backdo it, but then I was like, no, we're gonna be 3 different.
Yeah.
Price
Well,
guy,
he
right?
said it was short, but he said it was. He also said the keywords of liability. Because remember, in the other one, he was talking about if you have a right, then it's a certain purchase a certain way you have to do it.
Yeah. There you go. And then it says the customer had a short option in their account. So you forgot about that, Mo.
You said short?
Yeah, one of your current customers is short an option in their account.
Oh, I missed it. I got it right here.
Uh-huh.
Okay.
All right, next question.
Price got it right too. In the chat.
Price did?
Yeah.
All right, that's what's up.
Close
That's what's
purchase.
up. Got Sonny and Price on the same side. That's what's up.
Oh, that's rare.
All right. An equity options contract is exercised by an investor just prior to expiration. How would it take for the transaction to settle? 4 business days after the exercise, 2 business days after the exercise, 1 business day after the exercise. The transaction settles the same day as the exercise.
2T. 2 business there.
Wait, can you repeat that again?
Everything or just the answers?
Everything.
The question.
All right. An equity options contract is exercised by an investor just prior to expiration. How long will it take for the transaction to settle? 4 business days after the exercise, 1 business day after the exercise, 2 business days after the exercise, or the transaction settles the same day as the exercise.
2.
Okay, Mo says 2 business days. Anybody else?
Say 2.
Brandon got 2.
Yeah, I would say 2, unless I kind of didn't hear it again on what kind of account it is.
No, it's just a regular equity. It's just a regular stock option contract.
Oh, okay, yeah, 2.
All right. Yep. All right.
I remember the T2.
Yeah. All right. What is the cutoff time to trade an option in the secondary market on the contract's expiration date?
5:30.
3 p.m. Eastern Standard Time, 4 p.m. Eastern Standard Time, 10:59 p.m. Eastern Standard Time, or 11:59 p.m. Eastern Standard Time. What is the cutoff time to trade an option in the secondary market on the contract's expiration date? 3 p.m., 4 p.m., 10:59 p.m., 11:59 p.m. ET.
11:59.
4 p.m.
Okay, Sonny says 4.
11:59.
Mo said 11:59.
I'm gonna go ahead and say 4.
Brandon says 4 too.
Let's see what price
Oh,
is.
ooh, wee. Y'all was Brandon and Sonny was right. 4 p.m.
Wait a minute. Why? Because it's secondary market?
No, because it says cutoff time to trade, not to exercise, to trade
Okay. All right.
or expiration. All right, last question. Which of the following is the correct sequence if an investor sells an option but later trades it prior to expiration? Closing purchase, then opening sale, opening sale, then closing purchase, closing sale, then opening purchase, or opening purchase, then closing sale. So it's just a 2-part answer.
Repeat the
Which of the,
question.
which of the following is the correct sequence if an investor sells an option but later trades it prior to expiration? Closing purchase, then opening sale, closing sale, then opening purchase, opening sale, then closing purchase, or opening purchase, then closing sale.
It's gonna be the third one.
Opening sale, then closing purchase?
Yeah, that's the one I'm going for. Yep.
I'm going
Okay.
with Brandon.
I'm gonna go with opening purchase and closing sale.
Okay. Let's see. Brandon and Mo are right. All right. All right. That's all the
It
questions.
was opening. It was opening.
Open
It was
sale.
closing purchase and opening sale.
I was opening
Open
purchase,
sale.
closing sale. All right. All right. We're going to go to the next section. All right. All right. All right. This is the section that we did the other night. All right. Y'all ready?
Mhm.
All right. The option contracts. The Options Clearing Corporation. That's good, Mo. Now we can use what's on the screen. You hear me?
Yes.
All right. So the Options Clearing Corporation, OCC, we familiar with that. The primary options clearinghouse is responsible for standardizing option contracts. Standardization results in each contract maintaining similar characteristic, rules, and presentation. This structure ensures the options markets are liquid by making it relatively easy for investors to trade options. If each contract was customized, investors will be required to study the contract components before executing the transaction. All right, let's take a look at what an options contract typically looks like. And we can all look at Mo's screen. All right. Except for, all right, so to better understand the components of an options contract, we'll need to break it down, discuss each part. So, what is long, Mo?
What is long?
Future.
Right. Y'all clouded. Y'all trying to cloud me again. Right now. Long as you gonna
What does long mean?
I ain't I ain't I ain't gotta do nothing. Because you
Huh?
just want to clown me every time.
No, I'm not. I'm asking you a question. We just went over this earlier.
I did.
Oh my God, boy. All right.
You
First, it
instruct
will
me
say
to get
if the
mad.
customer is long or short. The contract. Long represents a purchase of the contract,
I told you buy it right now.
which provides a right to the investor. Short represents a sale of the contract, which creates an obligation for the investor. Okay? All right. So the one, what does the one represent, Mo?
One.
Oh God. We got people watching
One
in.
contract. One contract. Hey,
Okay.
you the instructor. You ain't supposed to get frustrated. Just teach the
Uh,
class. But
It's
go ahead.
one purchase contract.
okay. And
One
how much
buy.
is okay? How much is one contract?
100 shares.
All right. Next, what does ABC represent?
Company.
What company?
Ticker. Google. Is it Google? No. ABC. ABC. I forgot. Let me look it up.
No, ABC is not a real company. It's fictional.
Oh, well, but it's a ticker for the company if you were looking at it, right?
What I meant was it just represents the stock that you're trading.
Okay, we can roll with that.
Okay, and next we have, what does January represent?
Expiration date.
Expiration. Okay, and what does 50 mean?
That's strike price.
All right, and what is the call?
You want it to go up bullish.
Calls are contracts that give the right to buy stock.
Oh, buy stop. My bad.
All right, and at $4, what does the $4 represent?
Premium.
Huh?
The premium?
Yep, that's right. So $4 is what?
$400 is the premium.
Right. So, all right, good. So,
How much you
all
got?
right.
Mm-hmm. Ready?
Yep.
Okay.
So as you can see, long is ownership, purchasing the option contract, and you gain the right.
Mm-hmm.
One contract equals 100 shares of stock. ABC is a fictional company. That's the company you're trading. January is the expiration month, and it will expire on the third Friday of the month at 11:59 Eastern Standard Time. A 50 call, it's a long call, which equals a right to buy. That is the strike price. And the $4 is the premium. That is the cost of the options contract. That is how much money you would spend. And how we get the money you would spend is the one contract equals 100 shares, and you will multiply that times the premium to get $400. All right, so you can stop right there. And now we're going to go into examples.
Okay.
All right, so wait. Before we do that, let's get into calls. All right, calls are contracts that provide the right to buy an asset at a fixed price. If you were to purchase an equity call, you would gain the right to buy stock at the strike price. This right will only be exercised if the stock's market price rises above the strike price. For example, a $40 call, which provides the right to buy stock at $40, will be exercised if the stock's market price were above $40. To fulfill the holder's right, call writers are obligated to sell stocks at the strike price. All right, let's go through a few examples so we can get acclimated. All right, so one ABC January 40 call at $5 while the market price is $39. The market price subsequently rises to $60. What is the intrinsic value? Mo, get off that.
Well, it said he didn't have this part. You just went straight into it, so I was just trying to help.
Yeah. We went through what intrinsic value was earlier. For those that were paying attention, Mo know what intrinsic value. You don't have to use those slides, Mo.
I know, but it just helps.
So
Intrinsic value.
okay, let me read it again. Let's break it down, right? One ABC January 40 call at $5. So one contract of ABC stock January $40 strike call at $5, but the current market price is $39, and then the market price rose to $60. First, let's determine what is the intrinsic value. Who can tell me that?
It'll be 60 minus 39.
Wrong.
I mean, minus 40. I'm sorry.
Wrong.
What?
No, I'm just playing. Yeah. Or 40 plus 20. Because it's not minus anything since the stock went up $20 from your strike price. So remember, how you measure intrinsic value. Price is in the chat, right?
Yeah.
So intrinsic value is always going to be measured by the strike price. So the strike price is your contract. That's what you bought. And if you have intrinsic value, you always will add your strike price to how much the current market price is at that time. So in this example, the current market price is $60. Our strike price is $40. So that would be $20 of intrinsic value. Everybody good with that, right?
Wait, say that again?
So
No,
your
that last part.
intrinsic value.
Yeah.
So your strike price is $40. The current market price now is $60. So you have $20 of intrinsic value, or like a $20 gain.
Okay.
Got it? All right, cool.
Where you adding?
Why would I not? It's a call.
And you said the market, the strike price is $40,
Yes.
and
You bought a
the market
contract.
price was
Listen again. One ABC January 40 call at $5, while the market price is currently at $39, and then the market price subsequently rises to $60. What's your intrinsic value?
Are you saying market plus strike?
The intrinsic value is $11.
Wrong.
I mean $21. It's if it
Wrong.
goes up to $60. That is
Wrong.
the intrinsic value.
No.
You just confused me.
Remember, you bought a contract where your strike price is $40. So that's $20. That's a $20 jump from your strike. So 60 to 40 to 60 is 20, not 39 to 60. 39 was just the market price at that time, and then it rose to $60. Remember, your strike price is what your focus is. And then you look at the current market price, that is your intrinsic value. So yes, it was at 39, but then it rose to 60.
And
So
the call is at 50.
the call is at 40. Don't look what's on Mo's screen because she
Oh.
confused like that. So
If the call is at 40 and then it goes up 20. I mean the call up so yeah, your intrinsic value is 20 then.
yeah, you're right. That's right. I know it's getting confused because what we got on screen and what I'm reading is two different things. But Mo got that up there to kind of show you how it's broken down too. Even though, yeah.
See, it's a white person's version of learning, and it's a black person's version of learning. And it kind of throws people off when we try to mix both.
uh,
Well, I
so, yeah.
subtract. They add. It's the same thing to me.
But you don't do that in your option account. You don't subtract 60.
Yeah, I do.
Okay, well that's fine. I mean,
You
do
don't get the
whatever.
same answer.
I mean, that's why I say it's fine. Do it whatever way. I like adding when it comes to
I'm
money.
gonna
I don't
tell
like.
you exactly how I do, like how we're talking about the intrinsic value part. Like
Yeah.
I look at the options, I see how much it is in the money and how much I can make off of it in the money, and then I start looking at what's my value price, how much can I actually spend on this company as far as a put or a call option, and then
We gonna
that way That way it makes it on the page of where I can measure it out.
And we about to do that right now. Because now that's just the intrinsic value. Now we're gonna calculate gains and losses. So since this contract has $20 of intrinsic value, how much does the holder gain or lose? So one ABC January 40 call at $5. The price subsequently rises from
Are we
39
going
to
off of what Mo got on the screen or what you reading?
what I'm reading.
Okay.
So your strike is 40. The stock went from 39 to 60. So we already established we got $20 of intrinsic value. How much does the holder gain or lose?
So
$2,000 or 2,000 in stock and whatever the price was in the share.
which is
Hold on.
is
Brandon,
that
you want to
$5?
answer?
So that was 500.
Hold
That's
on.
25. So
Hold on. I want to hear Brandon.
Say it again.
Okay, so
$40,000.
what's your answer, Brandon, to this question?
I'm sorry. Repeat the question one more time.
So we got $20. The one ABC January 40 call at $5,
Okay.
and
It rose all the way up to 60.
yeah, so we got $20 in intrinsic value. How much does the holder gain or lose?
So if it
1,500.
rose,
Gain
you?
50.
I mean, oh no, she right. I mean, plus the actual because you gotta equate for the actual premium as well
Right.
that you pay for.
500. The
So
500
Sonny said 40,000.
Any tripping? Because I want to
is
know what goddamn stock is that, or what the hell you get 40,000?
20 times. Sonny did Sonny did 2,000 instead of 20. He did 2,000 times. It's 200. I mean, it's 20 times 100. It's 2,000 minus the 500 you already spent.
Yeah, I messed up. It was on I was tripping. But yeah, 4,400. He lost.
Mark,
4,200. He lost 4,200.
no,
Wrong.
he paid
No, that's
500.
just my answer. 4,200. Because
Oh.
if the actual price of it when he sold it, when he sold out the stock was when he sold out the call was 39. So he actually lost $21, and that $21 times what how many shares was it?
It did go
100?
it did go down and went up, right?
No,
No, but it's for the person who actually owns the shares. So it's not the person of the option, it's the person who actually owns the shares. He's saying how much did he actually lose?
No, Sonny.
No.
So no, it was a call, right? It's a call,
Oh,
and they asking how much did the holder gain or lose. So the person that bought the call is the holder.
Oh, I thought yeah, I'm way off.
Are you gonna do the Excel sheet, Mo?
yeah, because you told me it's confusing them. So I was gonna put
Yeah,
the numbers.
no, I'm thinking of it. I'm thinking of it. Okay, say for instance, I own Tesla shares, and I put out there, and I put I exercise some calls, right? And the people who buy it, say for instance, it was at 39, but then it goes up to 60, and they're actually winning in their calls. Say for instance, they want to exercise it to buy the shares from me. So I would lose. I was just saying how much I would actually lose if the calls actually went through
Oh,
that
you
way.
acting as the writer. He acting as
Yeah.
the writer. I get what he's saying. Okay. No. You're not the writer in this regard. This is just talking about the buyer. This is just the buyer by itself. We don't get to the writer part. But so the buyer has $20 intrinsic value, which is a $2,000 gain, and then you pay the writer $500, which is the premium. So you end up with a $1,500 gain. Everybody agree with that?
Mm-hmm.
And Mo, matter of fact, Mo, you can write this down since we're gonna be using this example. You can put the the January and all of that in there if you want to. Everybody, what do the people in the chat say? Everybody was good with that.
Price, yeah. Mm-hmm. Pricing and using algebra. Solving for X. Yeah, too much fun.
Yeah, boy.
What's it called when the stock went up? Market.
Huh? Market price.
No, this is the market price. It said it went up. Market price increased.
Yeah.
To 6. What's it called?
That technically will still be the market price, Mo. It just went up in price.
Okay.
Yeah.
Go ahead. I'm just.
All right. So, okay. So now, all right. So now we're going to let's talk about the writer. How much does the writer gain or lose?
The
He
writer gains.
goes 2,000.
The writer gains from that $5 premium.
Uh-huh.
So the first scenario was the what?
Was the buyer, the holder.
Okay.
Remember, buyer and holder is the same thing.
So wouldn't it go up to $100?
Huh?
It will go up to 100.
What you mean?
We'll go up to 100. The writer is the one who put that out there for 500. And so if it rolls, that means he's obligated for the whole thing if it's sold at 2K.
So remember
writer.
No,
I'm looking at it as 5 cents. Well,
yeah. Okay, I see what you're saying. Yeah. No, it's $5.
Yeah.
Yeah. You good. I got you.
So it'll be his gain would be it will be at 1,000 if it goes from 40 and all the way to a $60 strike price.
2,000
for the who?
If you saying that his strike price, right? Was $40 off of, and the original stock was $39. But then the original stock went to $60 and his strike price is at 40, right?
Yeah.
Then wouldn't you do it where it's the shares times the intrinsic value?
No,
you would do the
intrinsic value times the premium. I mean, not the premium. I'm sorry, the shares.
No,
that's what I just said.
It would be the strike. It would be the strike price plus the current market price. The intrinsic value is the difference between the strike and the market price.
Now you want to go subtractive when you said you was adding before. Boy, I tell you the
See,
truth.
this is why I say that. Just say it on the nigga
I
shit.
just say
This is
subtract.
how I would say it. Look, look. The regular thing was $39. It went up to $60 on the regular. But
Uh-huh.
when you bought the contract, it was $40. After it went up to 60 on the regular, how much should your contract be?
Remember, when you buy the
Okay.
contract, your strike price, we worried about the strike price compared to what the market price is. So if the market price was at 39, you don't have any intrinsic value. You out of the money. So when it went up to 60, now you in the money. Now you ready to exercise. Now you can close that at a $20 gain or a $20 intrinsic value. So you can just say $20 gain. So it went, your strike is 40, it went up to 60. So that's a $20 gain. So that's a $2,000 gain overall. And then you pay your premium to the writer, which is $500, and then you left with $1,500.
Wait, that's what I said in the beginning, though.
You
No,
said
you
that in the
didn't.
beginning?
No. No, he
I
didn't.
said that in the beginning. I just didn't say that.
You did not.
When I was telling you as far as times in it times the intrinsic value times how much shares it is, that equals out to the same shit. But you were saying that I was saying it wrong. But this is why I said, if you
Yeah,
say it
because
on.
you said 20,000. I was like, no, not 20,000.
No. I was saying as far as the if you go 20 times that 100, it leads you to making 2,000.
Yeah, no, that's
And
right.
so it's basically like if that's why I was saying if the regular price is 39 and it went up to $60, your contract is at $40. You done made $20. That intrinsic value would be times your shares.
Yeah, but at first you said 21. I was like, no, that's not it, because you was taking the current.
No,
You was taking.
not from the beginning of when we first started talking. I'm talking about from this project right now.
Oh, I don't know, Sonny. I can't tell you. We have to rewind the tape.
Yeah.
I don't know
But
what.
Mo, put seller by writer. No, in the back of it.
Behind it?
Yeah.
No, I got my phone number.
All right, so we got that.
This for my benefit. So don't be telling me how to do my spreadsheet.
Yeah, I'm gonna delete it.
I'm gonna put my numbers in. I'm gonna have the answers.
Oh, Brandon, hearing this foolishness from Mo.
No foolishness. I gotta get this. Go ahead. What's the next scenario?
Okay, so we talking about the writer now. So how much does the writer gain or lose?
We already know. We established that.
All right. Next question.
This is a
All right, next question.
next question.
All right, so
Minus.
I'm gonna let you get it together because you got someone.
Wait a minute. Hold on. Hold on. I need to get a negative number. There we go. There we go. All right, go.
All right. So
Hey, Mo, can you
now,
send that to me?
Sure. Let me save it. Go ahead, Chris.
all right. So same scenario, but the market price falls to $35. What is the intrinsic value? First, that's the first question.
You said market price falls to $35.
Yep.
Gotta fix my spreadsheet. All the numbers is the same.
Yep. Well, no, because the market price is not 60. It didn't go up to 60. It went down to 35.
Yeah, that's what I was trying to ask you. Okay. Let me so the market price, make sure I got my numbers right. It decreased, right? Yeah, I
Yes.
have a scenario for decrease and a scenario for increase. 35, 39.
It went from 39 to 35.
The intrinsic value went down 5, right? I mean, yeah, it went down 5, didn't it?
Wrong.
Mo, when you do that at your market price tab instead of market decrease,
Yeah, I have to wait,
instead
say
of instead of 39, shouldn't it be 35?
35.
To the
Oh, this one should be 35.
right.
That's what. Okay, let me go back and put that. 30. That's what I was wondering. Yeah, I did it wrong because it's supposed to show my number decrease right there. So I had the. No, that's right. He said it went down. Wait, Chris, repeat the scenario again. So is the market
What?
price? The market price. So the strike price is still 40.
The strike
Yes.
price is still 40, but it went down 5 on the side.
Yeah. It went down from 39 to 35.
Right.
So the 35 to the right of that should be 39, right?
No, he said that's what I got confused. I want.
Technically the 39 is not supposed is irrelevant.
I know the
So
strike price is 40, and the market price is what?
No,
35.
the market price, yeah, the market price would be 35.
So it went down 5.
Yes, that's what Sonny
Okay.
said.
No, I know I didn't hear him. I'm looking at. I'm doing something.
Okay.
Wait a minute. So how did? Oh yeah, you're right. Because we're doing intrinsic value. Don't get confused. No. So that's
And
what 5.
I can tell your little calculations is wrong, but
No, don't worry about this over here because I ain't got the formula right. I'm making it. Peanut head.
uh-huh.
Get off my computer. I'm creating me a cheat sheet.
You know it would be easy to write this down.
No, not for me. I gotta see it.
You said you gotta see it. What's better than writing it down?
Don't be telling me what to do. How to
Okay.
study.
All right. I'm gonna tell your boyfriend to tell you what to do now.
Well,
Because he can give you the belt.
I wish he would. All right.
Are we excluding how much data and time has passed?
No, we're not into the Greeks yet. This is just the basics and fundamentals. That's it.
So I don't need that spot. Well, I do need that spot, but I don't need that spot. So this, I should have put my my number right there because it's in my way. I have to fix my number sheet because this should be 5, and then it will be equals. Yeah, that should be 5.
The intrinsic value should be like what, 400 on the loss. If we're counting it at the you buying it at the strike price of 39, I mean buying it at 40, and the market price was at 39 when you bought it, and then it dropped down to 35. Uh, the intrinsic value decrease should have been 400.
Wrong.
It's not. What is it?
No, because it's 5.
So you have no intrinsic value.
Because it is 0. If it's negative, if it's low, when it drops, it's nothing go below 0, so you don't have an intrinsic value.
If
You
the
only have
price,
it when it's a positive, right?
if the price falls below your strike price, it has no
Yeah.
intrinsic value. So
Put
if
the new.
it doesn't rise, and
Right.
basically it's going to expire worthless, and then you lose your premium.
Definitely right. Wait, hold on. If you're buying it at $5, not 5 cents, and it only goes down $4 from where you bought it at, it can't go to 0.
Not if you don't exercise it.
I mean, we wasn't talking about a time frame. This was basic, remember?
Yeah, but the idea is that if you don't exercise the contract, or if it goes out of the money, you're basically gonna lose a premium. I'm not saying that you can't save it from not being not losing all of your premium. It's black and white here. So it's just basically you have no intrinsic value. I haven't got to the gain or loss yet. Either way, you don't gain anything. You still lose. Still lose money. What the heck is
I'm
my...
about to email you because I'm about to email Brandon.
Oh,
You're doing a good job.
yes, ma'am. So now we can ask, what does the holder or the buyer gain or lose in this scenario?
That premium. Oh, I mean, he just keeps the premium because
Why would he
right.
keep the premium?
He keeps it because the other person
The
who
buyer
put
keeps the
it,
premium?
no. Hold on, let me look at the thing. No, the wait, what did you
We're
just
not
ask
talking
me?
about the writer. We're talking about the buyer.
Oh, the buyer lost. The buyer lost his premium because the options the call went down, so he don't win nothing. He lost 0. He only lose what he paid, which was the premium.
Okay.
The writer gains the premium, which is the 500.
All right. Okay. So what does the writer gain? So
Writer gain the 500. Brandon, what's your email?
and that's it.
Oh,
The
shoot.
writer only gains 500.
Yeah, that's all they got.
You sure?
You said it wasn't no intrinsic value.
Okay, 500. All right. Okay.
Hey Mo, what you say?
Put your email in the back chat.
All right.
All right. So you're all good with that. Let's talk about puts. Puts are contracts that provide the right to sell at a fixed price. Investors who buy equity put contracts gain the right to sell stock at the strike price. Puts are exercised if the stock's market price falls below the strike price. For example, a 70 put, which provides the right to sell stock at $70, will be exercised if the stock's market price were below $70. To fulfill the holder's right, put writers are obligated to buy stock at the strike price. All right. Let's go through an example. Y'all ready?
Mm-hmm.
1 BCD 70 put at $3, while the market price is $71. The market subsequently falls to $55. What is the gain or loss for the holder?
Wait, say one more time.
1 BCD August 70 put at $3, while the market price is $71. The market subsequently falls to $55. What is the gain or loss for the holder?
Nothing. It dropped. Oh, the put. Oh, yeah, it did drop. Oh, see, I gotta see it. Hold on, I gotta write it down.
Did you say $51 or $55?
55.
So it was intrinsic value of 16.
Correct. Wait, wrong.
It was a put, right?
Yes.
And it went down to from 71 to 55.
Yes.
So on a put option, there's no intrinsic value.
It is intrinsic value. It's just not 16.
Yeah, great.
Remember, your strike, worried about your strike.
What was the strike price?
70.
Oh, I didn't hear.
Okay.
It was 15 then.
Yeah. So what is the gain or loss for the holder?
The holder gains 1,500.
You sure?
Yeah.
Brandon
Wrong.
Nelson.
Wait, no, you got it at $3. You said though, right?
All right,
Yeah.
thank you.
Got to pay that
Yeah,
premium.
I was tripping on that. They gain they gain 45. Wait, I'm over here in the middle of something. Hold on.
Take your time.
How you doing? All right. Yeah, it threw me off.
Mo,
What?
what's the gain or loss?
I don't know. I didn't even write it down.
That you need to write this down for. You've been through this already.
Man, you better chill because I'm sleepy like a mug.
Wake up.
I'm drinking some water.
And don't mess with her when she sleep. You know dang well don't mess with Mo sleep.
Brandon, you a smart man. I said some choice words to Chris.
No,
Wait your ass.
I knew Chris was gonna do that though.
You see that, Brandon? And he wonder why them girls be telling them off. You mess with them at the wrong time.
That's okay.
You see, that's okay.
You know
Woo.
what? They
Hello?
always come back to me.
Hell no.
I come back to you.
Yeah, Ned.
Sunny, answer the question so I can take a nap.
What the hell?
Y'all couldn't even Mo's
I think
bedtime right now.
I think we pretty much got this concept down.
So the overall intrinsic value of it would be what, 4,500?
Wrong.
What would be?
Oh,
You was
let's see.
right the first time. It was $15 worth of intrinsic value. The gain or loss was 1,500 minus the premium, which is 1,200. Remember,
So you would
yeah,
always minus the premium. Yeah, okay.
yeah, yep. All right, so we're gonna go to the next section. Since we pretty much got this one,
Oh no, on Wednesday?
huh? Oh, you sleepy?
Brandon, get Chris. No, y'all could go to it. I'm gonna be listening.
No.
She ain't listening, bro.
We
The
can
fact
just
that she said, "Oh no, Wednesday,"
yeah. We can do the rest Wednesday since
I can't take
she
kids to
tired as
school.
hell.
Yeah,
I
I'm gonna
can't.
have to talk to y'all later anyway.
I
It's about to
can't.
get dark
Hey,
out here and I'm in LA, so I'll
hey,
talk to
look.
okay.
y'all.
All
Price
right.
in the chat talking about Chris. She got a whole spreadsheet too.
Yeah, a whole spreadsheet. I'm like, man,
Yeah, to give me. Hey, after a while, they said if you ain't cheating, you ain't trying.
a whole spreadsheet. Good Lord.
That's all right. Wait till I perfect it.
That's good. That's cool. You learn it how you learn it. As long as you get it, you understand it.
I gotta see it.
Yeah. That's why I
I'm so
told you to
tired,
write
bro.
it down. You want to put all this stuff in the Excel. You got to go back to pre-technology. Write them shits down.
I got both.
From scratch.
I got both.
Okay. That's good then.
I just figured in the future, when we do it, I could pop that number in there and boom.
Yeah. Yeah. That's
I
right
can
too.
I can understand it. You know,
Hey,
I'm
Mo
looking
always,
I'm looking out for your classes in the future.
why? Because you made a spreadsheet.
Yeah. Yeah, because you can't be just talking to people.
Yeah, I
You
can.
know,
I repeat the question 3 or 4 times.
we know because we've been looking at this stuff for a while, but a new person, they may need some tools.
Oh, technology, huh? Okay.
But not just that, they can write it down too.
Right. I got you. And now
All
you
right.
want to sleep, and we ain't supposed to be done with class yet.
Shit, this been 3 hours.
You
Shit, you
spend
know.
two. You spend two talking about.
Nope.
Man.
I was putting the slides in order. You better give me
Oh,
some credit.
oh yeah, you did do that. You
You
did
did a
put.
good job though. This is a really good class. Um, and so I'll be glad we get to do some, look at the chart and then look at bar chart and then we make it make sense.
Yeah, you definitely got to expound on this a little bit because you just can't stop here. You got to keep going. Like if you can get on here bar chart, like you said, show some examples or some slides or
Yeah.
something like that.
Yeah, that's gonna come later. That's definitely gonna come later. Because right now I can't. There's no point of showing you a chart and you don't even know what premium is.
Well, I meant like the option legs and all that other stuff, the option chain and stuff
Oh
like
yeah,
that.
that comes later down the line.
Yeah,
First they need to just understand how to go on there and press a button to get to a call option or a put option to even
right,
see the weekly contracts and all that. That shit is gonna be Chinese to somebody.
right.
So, uh, but if we can write out what it is and then show them on a screen, they can start relating to it. So, and then it's really more important on how they work than going on there and pressing the button because anybody can do that. But if you wondering why your money ain't settled yet, it's because you didn't understand T+2.
Right.
So yeah, we definitely gonna get to that part to where they can get the screen down and then start looking at charts.
Talking
You
about with
know,
like the Greeks and stuff.
well, no, not that. That's
No.
that's advanced. Greeks is advanced. Um, this is just basic, knowing how shit work. What's a buyer? What's a seller? What's an opening transaction? What's a closing transaction? Closing sale, opening sale, so forth and so on.
Well, this is a really good video. If I was you, I would definitely cut that first part out.
What
Like
video?
I would slice it. I would slice this
Yeah,
in
What
part.
video?
clip it up.
This one.
Do short
Oh
clips on it.
Yeah,
no,
I would
that's not my content. That's probably copyrighted.
What's that?
The video she talking about.
this video?
Oh, oh yeah, for sure, for
You
sure.
tri- you tripping,
Yeah.
Chris.
Oh,
No,
he's sleepy too. He's sleepy
Sound like
too.
you
no,
sleeping.
because those screenshots is from a video. Those pictures right there, they're from a video too.
No,
So
this is your voice, so
yeah, this video we're doing, yeah,
yeah,
absolutely,
that's
and
what
you
I'm
can
talking
do
about.
that. That's gonna be your job. So,
Oh shit. Ain't gonna be my job because I don't even know how to do that.
She said,
uh,
"Shit."
oh, you don't know how to do it?
I try
Okay,
to get my niece to do it maybe. Or I could timestamp it for
yeah, yeah. Somebody can do the timestamps. That'd be great.
her. Yeah,
Um,
maybe Zion could do it because that was some really good scenario questions. I would like to hear that over and over.
yeah, we need to do it for both shows too. The one on Wednesday as well. Well, we were
Um
really getting into the meat. The meat. We ain't even
yeah,
got
but
into.
this one you gave us multiple choice. Wednesday, you ain't give us no multiple choice.
Oh yeah, because we didn't run through the actual quiz questions. So, yeah, yeah, I can do that.
All right.
Make sure y'all like, share, send this to all your friends and family, and let's get this out here. Appreciate y'all.
Good show, man. Good show. I like it.
Good
All right.
job, Chris. Thank you.